Take it away. Yep.
Okay. Hello, everyone. So today we have the pleasure to have Zheng to present his work on the private value of financial statement statistics. And it's a joint work with Russell London. And both Zheng and Russ are currently at the University of British Columbia. And so before we go to his presentation, let me kind of just some housekeeping stuff. Let's, make sure that we give Xin like the first 5 minutes uninterrupted so that he at least can tell us what his research uh, question is, and then feel free to jump in, and please use the raise your hand function in the participant so that I can see your order and will follow the order where you raise your hands to call the questions. And so I think Xin, you can take it away.
All right, thank you very much for the introduction. So hello, everybody. My name is Zheng. I'm currently assistant professor at the University of British Columbia. Today is my absolute pleasure to be here and present you this work, a joint work with Russell Longholm on estimating the private value of financial statement statistics. We're talking about perfect foresight. Both Russell and I would like to thank the organizing committee, especially Young, for inviting us to be part of the accounting design project and present. We are very grateful for this opportunity. We also would like to thank Vicky for moderating this session. So without further ado, let's get started. The title is pretty much straightforward. We're trying to estimate the private value of some financial statement statistics. Why do we decide to do this particular project? It's because investors face time and resource constraints, and financial statement analysis gives a very long list of statistics that the investor could use a lot of time to study and acquire information on. When deciding on how much effort to expend forecasting one part of a firm's performance, the investor is necessarily trading off learning about some other aspect of the firm, depending on what the investor already knows and how valuable learning the new things expect to be. So our paper provides theoretical and empirical guidance or evidence to help with this problem by measuring the private value of knowing different financial statement statistics. So the specific research question we're asking here is, if you're trying to forecast F and you already know Z, and how much would you pay to learn Y? F is the firm's next year return or any assets next year return. Y is the next year's value of some DuPont model statistic. And Z is the current value of Y plus 3 controls for expected returns. And when we are executing, so we have a model in our paper. We also do some empirical tests of our model. When we are executing and estimating the value of some statistics, we are focusing on DuPont model decomposition, the advanced DuPont model decomposition. And that's basically the research question. And when we talk about the private value of statistics or perfect foresight, we are talking about the value of being the only person or investor in the market who knows that particular statistic, given that everyone knows the public information. Okay. A quick preview of our results before I start taking questions is that we find that knowing the next year's ROE, return on equity, is worth 6 times more than knowing next year's sales growth. And second, we know that next year's leverage is practically worthless, it's not worth very much. And third, the value of knowing next year's operating asset turnover depends on the level of this year's operating profit margin. There's an interactive effect there between those two financial statement statistics. And lastly, the value of knowing next year's return on equity generally increases when an industry ETF exists. So in our tests, we not only do one asset test, we also do 2 asset tests, allowing investors to trade both a firm and an industry ETF. Okay. So how does our study fit into the literature? The residual income model by Olson 1995 shows that the value of a firm can be written in terms of the forecasted future ROE and growth in common equity. Vicky, if you see any questions, feel free to interrupt me and let me know.
Yeah, so far, no, but I will just
Okay.
call them up when they raise hands.
Sounds good. So our Olson 1995 has motivated very large accounting and some finance literature aimed at forecasting these two drivers of value, ROE and growth in common equity. So for example, there's a large literature by Terry Young, Fairfield, and Young, Nissim, Penman, Zheng, and Solomon 2008. They find that asset turnover is more persistent than profit margin. And Amir et al. Extends this literature by showing that profit margin does better at predicting future returns on net operating asset. And other papers have allowed the estimates of variables persistence to vary with some other attributes, such as life cycle of a firm, operating versus financing, contributions to the ROE or firm industry decomposition, etc. We also know that, however, these studies tell us how to condition our persistence estimate to better predict future ROE, but not what one or an investor would pay to know better predictions of any statistics, right? So maybe return on equity isn't a valuable thing to know, and persistence likely works against being valuable. For example, as you get last year's realized persistence for free. Therefore, I think our paper contributes to this literature, but also differs from the papers in this literature. Then we have this market efficiency or inefficiency literature that tells us how to take existing publicly available data and predict future returns. But those papers, again, says nothing about the value of knowing private information or having a good prediction of the private information. And moving on to the short window return studies around some announcement, those studies are very precise in terms of estimating private knowledge of a particular announcement, but they cannot measure how other announced data or specify what has or hasn't been controlled for. Okay. More relatedly, I think we're citing quite a few Laura Veldkamp's paper in this slide and next slide. For example, Neuwerberg and Veldkamp study the trade-off learning a lot about a few stocks or a little about a lot of stocks. But the key assumption in their study is that the investors already know what to study, just not which firm to study. Whereas for us, we allow the statistics to vary, okay, and allow the investors to choose which are the most valuable statistics to focus on. And Farbuti et al. 2022 study the value of growth, GDP growth information, and we borrow their information function from their study, but they are looking at higher level information such as GDP growth information and aggregated IBES forecast information, how that predict next quarter's GDP. And we use their value function in a different setting.
Yang has a question.
Yeah, Yang.
Hi, Zheng. I just want to confirm that compared to Laura Veldkamp's work, her work is kind of more about whether firm-specific information versus the market-wide information. how to compare those two different information set, and then to see when investors acquire multi-firm economic-wide information versus firm-specific. But your study is more kind of like assuming that firm-specific information matters, is important. We want to see which component of the financial statements regarding firm-specific information matters more, and then try to rank them relatively. Is that a fair summary about how your study differs from Laura's work?
Yes, absolutely. That's a very good summary of that. And basically, they in their paper, they just allow the investors to choose where to they allow investors to choose which specific firms to study, but the investors already know which financial statistics to study, right? But here we allow the ranking of the importance of financial statement statistics. Yeah. All right. So why are we trying to study the perfect foresight of the next year? So basically, financial statement analysis is the process of moving from knowing the past to forecasting the future, right? So when we are estimating the perfect foresight of statistics in question, we are providing the upper bound value for that particular statistic, okay? So basically, we are trying to say that investors can only get smarter with more additional information, and we're trying to estimate that the value of that particular additional private information. So if we will, we can assume the realized value of a firm, P1, to be written as a sum of common equity at time 1 plus a series of expected residual incomes in the future, discounted back to time 1, given the information set at time 1. Okay, where the residual income is the difference between that income minus the risk-free rate multiplied by common equity last year. And we can write the same model at time 0. And when we take the difference of those two models, when we use a P1 minus P0 and apply the residual income, we get the very last equation on this particular slide. When we I'm going to carry this equation to the next slide, and it's on the top of the slide right now. When we take a closer look of this particular equation, the left-hand side essentially is talking about the gross returns, right? And the right-hand side, what's more interesting here is gross returns depends on the changes in beliefs about future residual income at different time points. If you may see on this slide, I have two little orange arrows pointing at information set 1, I1, and information set 0, I0. That's basically saying people and investors' information set has changed and beliefs have changed at different time points. Okay. And we know that the residual income can be rewritten in terms of ROE and common equity. So there is an interaction effect between profitability and growth, and essentially profitability and growth drives returns. I see Stephen has
Stephen.
question. Yeah.
Yeah, Zheng, you've
Hi.
got a constant discount rate here, R. Okay, so
Yeah.
the firm is making losses, negative ROE, and suddenly it realizes, gets a lot of customers, it realizes a lot of earnings. One would think that might become less risky, okay? And that would be reflected in the price also.
Yeah, definitely. And our model is pretty general, so that you know, we allow any kind of information to come. And when the information quality is good, and the investors eventually will realize that, right? So when there's negative common equity and they won't know it's bad later on when it realizes.
Hi, Shane. Can I kind of follow up on Stephen's question? I think he's asking about the R here in the denominator
Mhm.
can be also conditional on information I1 and I0. So the updating, whenever there's accounting information come in, release in each period, for example, 0 and 1. Right now you have the numerator updating the residual income, that is the future residual income information, but in the denominator, that R can also conditional on I1 or I0.
Right, got it. Sorry, I misunderstood your question. So yes, we did not update the expectation about the risk-free returns in this particular model. And here we are trying to motivate the use of DuPont statistics. Rather, we're using this example to tell you guys why we're focusing on DuPont variables. But I see your point, right? But essentially, this risk-free rate does not matter in our final model. Does that answer your question? So here we're just trying to use a valuation model to motivate the use of DuPont variables for our estimation.
Yeah, I think you answered that. I think your results, if you go to a few slides before when you have your research question,
Yeah.
Yeah, I think this one, yeah. So that you are actually comparing the covariance between F and Z with the covariance between F, Y, and Z, right? So that you can include with us updating cash flow information or updating risk information. It's not doesn't have to be only related to the numerator information, right?
Yeah, I think Jim Olson also have a question.
Yeah, please, Jim.
Okay, I can read out the question on the chat. Jim is asking.
Can you hear me?
Okay, yeah, we can hear you.
Yeah, it's just a matter of that when you write RIT is equal to a common equity times ROE minus R, then you have a covariance term there in the analysis. And this covariance analysis has to be dealt with. In other words, to rewrite residual income into the product of two components is purely mechanical, and what you introduce is now the relevance of a covariance term. And it's not done subsequently. Am I clear?
Okay. I apologize, like my audio is really bad.
No, I mean, it's just a matter of doing it right from a mathematical point of view.
Right.
So when you start to take these expected residual incomes, you can't just think about it as the product of two terms without introducing the covariance term.
Got it.
The product term.
Okay, so we should incorporate that for sure.
Yeah, but you can't, you see. You can try to do it, but people tried that before, and usually what we do is just to finesse it.
Okay.
So do you have any
suggestions in terms of how we can improve then?
Yeah, I mean, in other words, what you're trying to do is to go from residual income valuation model. Yeah. And then the attempt is to split it into two components, the expected common equity and the expected profitability. And the reason is that people like the idea of that residual income model deals with expected return on equity. Right. But it doesn't by itself. It cannot be done.
Okay.
That's my claim, for what it's worth.
Okay.
Yeah, if you're looking at just 1 year ahead, it's not a problem.
Yes,
because you don't have two random variables there. But if you go more than 1 year ahead, then you've got the covariance of the numerator and the denominator to deal with.
Correct.
So, and essentially in our model is 1 year ahead, and our estimation is also 1 year ahead, but your point is very well taken.
Yeah, but yeah, it's just a matter of that the top of the slide has this expression.
Mhm.
And what I'm saying is that if you follow through on that, you cannot break just residual income into two product components.
Yeah, got this particular point. But still, we can make the claim that, you know, residual income somehow is driven by profitability and growth, right?
No, not in my mind, but you can do it.
Okay. Yeah.
Not
So
in
I
my
think-
mind.
Right. Definitely. You have a lot of work in this area, and also there are other research and textbooks showing, you know, the residual income can be written in such forms, and yeah, we will think
Yeah,
about.
I mean, it's an error that goes back a long time.
Right. Okay, but thank you for your comment, and then Russell and I, we have to think about how we want to make a better motivation here. Yeah. So, but still in our current version of the paper, we are focusing on the advanced DuPont variables, and specifically, we are decomposing ROEs into the sum of return on net operating assets plus the financial contribution to the ROE. The financial contribution would be the leverage multiplied by the spread, and the spread goes back to RNOA minus net borrowing costs here. And when we talk about growth in common equity, that flows to the valuation model. The growth in common equity essentially is a difference between net income and dividends. So somehow it's highly correlated with return on equity. So for this reason, not only we're going to focus on growth in common equity, we're also going to focus on the growth in total assets and growth in sales as well in terms of estimation. Okay, so here comes our model. Our model is actually very general. We just model our hypothetical investor using the rational expectation equilibrium model. And this is generally just general enough and can be applied in many scenarios. We assume the investors have negative exponential utility with risk tolerance rho. And there's a single riskless asset that serves as numeraire. And there are n risky assets with payoff factor F, they're all normal. And public signal vector is represented by Z, and we have the potential private signal vector Y. Okay, investors can.
I think Stephen has a question.
Yeah, apart from Zheng's comments on ROE, you're talking about the common equity. I'm not what you're doing about that, but ROE is affected by payout. So you've got to know the dividend to know the ROE, but the dividend, you know, under M&A is not supposed to matter. So that's a bit of a tangle. ROE is affected by dividends, but you don't pay for the dividends, but you're going to pay for an ROE which is affected by dividends.
But how?
And capital contributions and so on.
So what are you trying to say here? So we should.
Well, the ROE in the future is going to be affected by dividends, because it's this ratio rather than the residual income. And would you pay for knowing the future dividends? And under M&M, you would not pay for knowing the future dividends. You pay for the residual income, but not the ROE, which is affected by the dividends. So what you're doing is you're buying dividends. When you're buying ROE, you're buying dividends, future dividends. And that's supposed to be not relevant under standard M&M assumptions.
Got it. Okay. And It is.
The ROE is a your problem here is ROE is a ratio. It's a ratio of two random variables, but it's also affected by the dividends. It affects the numerator, the denominator more differently from the numerator, and so that's affected built in just deterministically to ROE. You're buying, what you're doing when you're buying ROE, it's dependent on the future dividends, but they're not supposed to matter. Okay. What you want to buy is sort of value added to book value.
Got it. But also here, we're just, our focus still just, trying to figure out what financial ratios from the DuPont model that matters the most to investors, right? So I see your point that investors could have different ways of valuing a firm, and we chose this particular way of doing so. Yeah.
Yeah, well, if you're just dealing with RNOA, you're getting rid of the leverage, but you still got the effect of investment on the ROE, and investment may not necessarily add value in the rate, even though it adds to the ratio of RNOA.
So another way of stating this ratio would be we can take it out, or
the whole problem is you're working with a ratio here. You got Jim's problem plus my added problem of being subject to investment and dividends. Investment may not add value.
Right, but also there's also quite a large of literature saying all those ratios definitely matter, right? So
now the ratios, most of the literature is looking at the ratios now. Okay, I look at the ratio now, and that with how that forecasts residual income in the future. Okay, but if you bring in the ratio, you got this problem that maybe you're forecasting this ratio, but this ratio is subject to dividends and investment and stock repurchases.
Right.
If you like, after the session, I'll take you through it. Okay.
Sounds great. And maybe we can incorporate different things, but here we are solely focusing on those ratios that we think that matter most in our setting. Because Russell has a textbook basically just saying all those advanced DuPont model decomposition, they're quite important, right? Yeah. And in terms of the value information, how we put a value, assign a value to any specific information, we borrow this value function from Admati and Flitier, 1987, and Alice and Lonholm, 1993. They derived this value of information function, and the F is next year's returns, Y is the decomposition of the DuPont model statistics, and Z is the current value of Y, and rho is the risk tolerance. So there are three things we need to estimate. Rho, we're going to talk about it 2 slides from now, but now I'm going to tell you guys how we estimate the numerator and denominator in the log function. So in our estimation, we first do the one asset test in which we first regress next year's return on Y and Z vectors. This is the full model. And then the mean squared error of the residual from this regression is going to be the MLE estimate of the posterior variance given both public and private information. And then next, we're going to regress next year's return on the Z vector, and the MSE of the residual is going to be the estimate of the posterior variance given public information only, okay? And we're going to then plug those two posterior variance into the value function here and calculate phi, the value of that particular statistic. And when there are two risky assets. The posterior variance is going to be 2 by 2. The steps are going to be slightly more cumbersome. First, we're going to regress next year's return on both public and private information and record that as the very first element in the 2 by 2 matrix. And then we're going to regress the ETF return on both public and private information and record the mean squared error as the 2-2 element in that matrix. Next, we're going to compute the covariance between the residuals from those two regressions above and record them as the off-diagonal covariance matrix. And we're going to calculate the determinant for the posterior variance of F given both the public and private information. And that would be the determinants from the full model here in the 2 risky asset. And we're going to repeat all those steps using only the public information in the Z vector and calculate the determinants from the determinants of that posterior variance of F given just the public information. Lastly, we can plug in the rho, the risk tolerance, and calculate the phi value, the value of information. Okay. And how do we estimate the risk tolerance? We basically follow Farbuti et al., Laura Veldkamp's paper, 2022. So if we are only making relative statements, we are comparing 2 phi functions, right? Phi1 divided by phi2, basically, then the rho cancels out. The relative statement we can draw does not depend on rho at all. It all depends on the numerator and denominator, the determinants that go into the log function. Okay, but we also try to assign a value, dollar value, to each specific financial statement statistic. So the first problem we need to solve is that we're making the assumption of constant absolute risk aversion, and that's unrealistic, behavior speaking. So we borrowed Laura's work, and we are solving for a local solution where those two functions meet, both the negative exponential utility function and the relative risk aversion function, okay? And we arbitrarily choose to allow the retail investor to have $1 million to invest, and the institutional investor in our setting to have $100 million to invest. And we get the risk tolerance rho to be $72,359 for the retail investor, and the rho to be roughly $5.4 million for $5.4 million for the institutional investor. Okay. So how do we estimate the phi function? We use all the firm year observations from CompuStab.
Zheng, Stephen have another question.
Yeah, Stephen.
I'm sorry to interrupt you again, but
Oh.
you know, you're giving these folks $1 million, whatever. But you know, if I got perfect information, then I go and borrow. I lever, right? So that the value of private information is that I can really lever, go out and borrow as much as I can, as long as I can persuade the bank that you know, of what I'm doing. So because you just go out and borrow and you magnify that that gain.
So but but people don't know the perfect information next year, right? At time 0.
But you're hypothetically giving them the information, aren't you?
Oh, we're estimating how much that's going to be worth.
It's going to be worth a lot more if I can borrow.
We did not consider that leverage part in our model and in terms of estimation as well. Yeah,
Jim has another question.
yeah, please go ahead.
No, I better stay away. My only comment is the extent to which you have to argue that the input is going to deal with these distributions of Fy and whatever have you, and presumably and then determinant is also going to be random variables. So I think what would help if knowledge about where these distributions are coming from and what they are.
Okay, we can do
In
a
other
little.
words, the calculation, the starting point has to be you have a determinant. This determinant is a random variable, and it depends upon the conditional distributions. Your conclusions presumably depends upon assumptions on empirics, and one would have to have a sense of a flavor about these things.
Okay, got it.
In other words, yeah. So what's the distribution of a determinant looking like? The determinants seem to be very important when you look at the formulas. So therefore, as a reader of a paper, I would like to know what are these determinants all about from a distributional point of view.
Okay. So
and then you have to take the correlation between, I don't know, I mean, in other words, the row to the left-hand side in the second bullet point, that is a random variable. Am I correct?
the phi?
Yeah.
Why?
Yeah. Yes.
So one would like to know how one ends up with this random variable. And given that the phi is a random variable, then ultimately, how do you turn the phi's into a conclusion?
Okay.
Presumably, this is what you're doing. All I'm saying is that one gets a little bit lost here, maybe. You know, and then the issues are, of course, that the variance here is really an enormous matrix under normal circumstances. But the key thing is that the determinant one needs to know, and I think you talk about that, the size of the variance covariance matrix. And the question is how you go from assumptions or empirics to the random variable phi. And then one wants to know, given that phi is a random variable, how do we arrive at conclusions?
Okay, we can definitely do a lot more description when we are estimating the phi value. But in our model, all those are pretty general, right? So we don't make any assumptions at all related to the determinants distribution. And I think one thing we can potentially do in our next draft we've been thinking is not only just using existing data from the stock market, from CompuStat and CRISP to measure and estimate the phi, we could also do a simulation, right? And see, you know, in a perfect world, what would this distribution look like? And we can incorporate analyst forecasts and see between the lower bound and the upper bound, which is our estimate, what in the real world those determinants would be looking like. And we do not have any ex ante you know, predictions, because analysts, they're not monolithic and they do their own thing. So that could look, yeah.
No, it's all fair enough. All I'm saying is that you have all sorts of modeling going on here, and the modeling has to be turned into empirical conclusions.
Right.
And what would like to know is sort of the big picture, how to think about it.
Oh, absolutely. Okay. So in terms of determinants, if we're only looking at the general intuition from phi, right? So the denominator here in the log function, determinants of posterior variance of f, the asset value, given both the public and private information, that will only improve as more information, private information arrives. Therefore, the determinants will shrink, the denominator will shrink, and the investor is willing to pay more to acquire such private information. That's a general intuition. But your point is well taken, and we should do a better job in terms of like bridging our model and then to what's happening in the estimation and in the real world, and give a better interpretation.
Yeah, I mean, again, I don't want to harp on it, but many people would view the model you're referring to by Adamant and Fleider as being, quote, what you call, it's very academic. It doesn't look very practical, but somehow what you do is to turn it into a practical tool. And that needs some overview because for obvious reasons. In other words, ultimately, the idea that you have inside, that you have advanced information is useful, makes a lot of sense. But then you come up with conclusion 6 times and so forth, and it seems a little bit eccentric.
Gotcha. And we are, to be honest, we are struggling a little bit in terms of making more practical suggestions. And that's that's one of the feedbacks we constantly get, and we definitely need to improve upon that.
I mean, simple models would be a virtue. And if you look at this model that the theoretical paper there, they assume normality and negative exponentially preferences and so forth. All of that can be easily bypassed if you just use quadratic utility and or mean variance analysis, because the conclusions come from mean variance analysis.
Yeah.
And so that's something that people can cope with, mean variance analysis, optimal portfolio choice. And then you can write that down, and then you can check up what happens now if I have more information.
Yeah, we can do that. Thank you.
Yeah.
That's very helpful. Appreciate it.
Yang has another question.
Please go ahead.
Hello, Zheng. I
Hi.
have kind of a similar question. I feel like in terms of this methodology, thinking about the prior studies is using Z, which is the current value, right? Current information to predict the future return, which is your S. And your paper is adding this Y, which is the perfect foresight future accounting information. And I understand that the model of the theoretical framework is very naive, assuming that this Y is somehow random across firm, within firm across time. But somehow I would like to see a little bit descriptive, because here you are capturing firm-specific information, and we all know that idiosyncratic volatility is actually not evenly distributed across firm, and also kind of conditional on different distress conditions or situations, right? So some descriptive on how this ratio, this phi actually is differed across firm, across different firm characteristics. That would be helpful to us to know whether your measure is capturing some heterogeneity instead of just the average value that investors are willing to pay.
Okay, got it. Okay.
The second comment is that how to validate that this is indeed the private value that theoretical investors willing to pay. Well, given that right now, like a lot of survey tools is available, right? You can survey them, right? Going back to Steve's earlier point is that they can borrow money if they have a perfect information. So can you use a survey as a complementary method to kind of reconcile with what you estimate here as a dollar amount? Because in the asset pricing literature, people always use the realized return as a future kind of like, or the required cost of capital. But I do see there's some survey evidence, for example, on endowment fund managers or et cetera, to ask what's their expected cost of expected return compared to the realized return estimated from stock return data. So you can also do the same thing here. Like Amazon Turk or all the other things to kind of do an experiment or survey to complement with the estimate here.
Okay, thank you, thank you. So I think both comments are very helpful in terms of bridging our findings to practice and make it easier for people to digest. And related to your very first comment, we can definitely describe phi's distribution a lot more across industry, and using other statistics as well. And later on, we do have a 2 asset test where we allow investors to trade both a firm and an ETF, and in which, and we find when the a firm and ETF covariance is high, phi value also increases, which is one very important and interesting point, and we can explore more related to the phi distribution and characteristics with phi for sure. And your second point is well taken as well. We could certainly do a bit more in terms of in real life how investors, funds would value private information and how they can leverage such information in the future. We definitely did not consider the leverage part at all. So yeah, it's something we could do. Yeah, thank you.
Zheng, can I add a question on this value information? Would the persistence of Z also matters?
So
Z and Y.
Right. So in our model, everything is very general, right? So, and if you think about persistence, essentially, the persistence of Z doesn't matter because it's public information for all. And persistence of Y may matter in the sense that if Y is very persistent, which means you get last year's information for free, right? So if it's, Y is very persistent, then this year looks very similar to last year's Y, then the investor will not pay so much for this year's Y.
Yes. So Yang.
Yeah.
So a quick follow-up on persistence. I think you have a very nice result between consumer non-durable goods versus durable goods. So think about durable goods will be something related to what Jim talked about earlier, is those are the irreplaceable kind of investments ex ante, but somehow the future return of something could be a little bit more persistent, or vice versa. But I kind of feel like your results between durable versus non-durable goods has something to do with investment and also persistence of future signals. Yeah.
Right, definitely. Thank you. So later on, we do have a, we can actually go there if you wish. I do have a result here where we rank the value of next year's ROE based on Pharma French 12 industries. And we see that the next year's ROE, the perfect four set of ROE, is most valuable in the consumer non-durable industry, but the least valuable in the consumer durable industry. And if you think about those two industries, what's the big difference is the level of discretion the consumer has in timing their purchases, right? So, and then this causes information about next year's ROE to be considerably more valuable when consumers have very little discretion, such as when they have to consume food and clothing, and probably because growth is well modeled, but profitability is more uncertain there. Yeah. Any additional questions? Okay. So how do we measure some of the information here? The payoff F is next year's return, and that's something we're trying to forecast. And the private value Y is the 7 DuPont variables and 3 growth variables for next year. And the public signal would be all the information, all the variables we use in Y vector for year T this year, plus 3 additional controls, which is size, common equity, book to market ratio, and momentum, which is this year's stock return.
Stephen have another question.
Sorry, yeah.
Yeah, You know, the asset turnover and the profit margin, again, you've got the problem of these are multiplicative with respect to earnings. So they're two random variables which can be correlated. So, for example, you could have a higher profit margin, a lower asset turnover with no effect on earnings at all if they're negatively correlated, which I believe they are. So, and of course, the sales growth comes in it also. So you got correlation here between random variables, which, getting back to Jim's original point, but actually applied in another stage here. That they're not independent. Okay, so you can't just buy the profit margin without buying the asset turnover because they're correlated.
Absolutely. And I think that's one of the more interesting, more nuanced results. In our paper, we definitely acknowledge there's an interaction, for example, between operating profit margin and asset turnover. So on this particular slide, I'm showing you the value of asset turnover based on operating profit margin, right? And we rank the operating profit margin into quintiles, and then we show the value of operating asset turnover across different quintiles. And you see from quintiles 1 to 4, based on operating profit margin, there's a steady increase in terms of asset turnover's value to both retail and institutional investors, but that dropped for the 5th quintile of operating profit margin. So there's definitely a multiplicative and interaction between operating profit margin and asset turnover here. And that's one of our message in general, right? Like when you are trying to forecast asset turnover, it matters probably more at some point, but not in the highest quintile of operating profit margin. And we did
if they're correlated and you're ranking on asset turnover within operating profit margin, they're correlated. That the second rank is actually a rank on the first variable because you're not holding it at a constant at a point. So you could be, when you're ranking on asset turnover, you could actually be ranking on the partly on the profit margins if they're correlated.
Right. And is there a better way of showing this then? They're definitely correlated. I think.
Well, we typically want to hold it a constant hold it at a point. A regression, you do that, of course. It's very hard to do this in the portfolio setting, but I actually just to report what the correlations are within these portfolios would be helpful.
Definitely, we do have that table, and it's not in my presentation, but they are definitely correlated. I think all the statistics in the DuPont model, they are to some extent correlated, and we cannot avoid that at all. But we can acknowledge that better in writing. And
yeah, Zheng, I'm wondering, can you do a 2 by 2 sorting? So like just one the column maybe is operating margin and the other on the asset turnover to represent the results. Then if you look at the row, right, relatively, one variable is fixed. Just relatively, yeah.
Yeah. So here
instead of present this way 2 by 2 sorting and see the results.
Okay, we can do that. Yeah.
So Zheng, this is my last question. So Oliver Benz and Catherine Schiffer, they have a paper using machine learning algorithm to kind of like understand the nonlinearity across those DuPont components. They can like decompose RE into 4 components and then try to use the algorithm to kind of understand that which level of disaggregation and also interactive effect across 4 will actually yield, well, again, using future return as a benchmark to yield a better accuracy or forecasting rate. Well, the downside of that approach is that they cannot really show the 2 by 2 or the sorting you show here because the machine learning give you just the accuracy rate at the end. But they try to kind of iterate different structure, different input data, and then to understand the kind of interactive effect. And then using the algorithm, you are able to throw in a lot more variables, right? Because here you have 2 by 2, but what if you put the third variable to the situation, for example, dividend, investment, and ROE, and then things kind of exploded. You can actually report a 3D cube. But in that situation, they are able to throw in as many variables as possible. So I encourage you to take a look at it. I don't think there are room for both methodologies, but kind of like somehow you can complement your findings with what they find using another method.
Sounds great. We can totally take a look, and thank you for this comment.
Zheng, just to let you know, you have 5 more minutes.
Okay, sounds great. Thank you so much. Given the time I have, I think I'm going to quickly overview some important findings in our paper. So on this particular slide, this is one of our main findings. We estimate the value information when trading one firm or valuing many firms one at a time. So the very first row, estimate the value of perfect foresight of next year's ROE, given that the investor already knows the realized value of ROE this year and 3 control variables. So although we report R-squared ratio because it's a common measure of fit, but the real statistic that goes into the value of information estimate, that is the MSE ratio. Think about the determinants, right? The result is that our hypothetical retail investor with $1 million of wealth values next year's ROE information at $2,515. And the institutional investor with $100 million wealth values it at $188,680. Okay. So I think it's a nice result for us to be able to put the dollar signs for each particular information, because we can compare them across different types of ratio. So here, the second row of this table estimates the value of foreknowledge of sales growth. And you see the sales growth is only worth $447 for retail investors, approximately $33,000 for institutional investors, which is significantly less compared to the amount of money that retail and institutional investors are willing to pay for the foreknowledge of ROE next year. And very last row here, we throw in all the variables into the model. And when we compare the value of ROE versus the value of next year's everything, we see that ROE alone accounts for approximately 72% of the value of everything next year. Okay. And I'm going to skip most of the analysis, but we did do, as Steve was pointing out, we did do a lot of analysis to show the multiplicative nature of some ratios, such as ROE and sales growth, operating profit margin and asset turnover, leverage and spread, etc. And lastly, we not only do a one asset test, we also expand our analysis by allowing the investors to trade ETF as well. On this particular slide, we're showing both the 2 asset results and 1 asset results. We rank the different industry estimates by how much value of knowing the next year's ROE is for when allowing the ETF trade. Okay, and it values a lot more for telecom, but very least for utility industries. And when we did a further analysis, we find out that's driven by the covariance between the firm payoff and the ETF payoff. To conclude, we develop a method for estimating the private knowledge of future realization of some financial statistics. And this method is pretty general and can be applied to any financial statement ratios, and provide some suggestions to investors when deciding on where to expend their time and resources in financial statement analysis. Before I let you go, I would like to announce the next accounting design project event, which is from noon to 1 p.m. Eastern Time on Tuesday, December 5th, 2023. And Ron Isim from Columbia, he will present the paper titled Profitability Analysis. Thank you all very much for coming and all of your comments and feedback. I will remain here for another few minutes to chat, but thank you so much for coming. I appreciate it all.
Yeah, thanks everyone for coming, and thanks Zheng for share his work with us.